Hi, this is Linda Hitt. We're going to talk about accounting for corporations in this video clip. And first we're going to start out with just basic characteristics of the corporate form. Good points and bad points. The pros of the corporation is the reduction to liability of the investors. If you're a sole proprietorship, you start your business and you don't do well, then you can lose more than your business assets. You can actually lose some personal. At least with a corporation, if you're an investor and you pay $100 a share, the most you can lose is the $100 per share. As painful as that might be, it's better than them coming after you for your personal house, possessions, and so forth. Also, a big plus as made corporations so popular is that you can quickly become an owner and just as quickly get out of ownership. So you can sell your stock usually over one of the exchanges and go through your stockbroker or online trading or whatever. And as long as the stock's being traded, you may take a loss. You may have to pay a lot of money up front, but that's a big plus, which is not true for something like a sole proprietorship. Corporations probably have more resources because they can raise money with different types of debt, such as bonds payable, which a sole proprietor probably has no access to. And because of this, they could probably also devote more resources to hiring management that has certain expertise. Rather than one person, they can go to many people. And if one owner leaves a business, the business continues. So with sole proprietor, if the one owner goes out of business, then that's it. You've got to sell off your assets or find somebody to buy your business. On the downside, the corporation does have some negatives. Taxation is one of them. The corporate form is a separate legal entity, so it is taxed, and it's a progressive, tax rate. So the dollar that corporation makes is taxed at the corporate level. If that dollar is then paid to the owners as a dividend, they have certain tax consequences too. So that's a definite drawback, which is not true for some other businesses like sole proprietorships. There's also more red tape, more regulations. They have to, follow rules if they're trading over the exchanges. Securities Exchange Commission oversees this for publicly traded companies. And certainly setting up the business, you just don't hang out your shingle like you might with the sole proprietorship. You have to set up, bylaws, board of directors, and have certain meetings, and so there's more going on to getting it started and keeping it going. Specifically, let's take a look at different types of ownership. Common stock is the major group, of owners. All corporations usually have common stock. And there's different descriptions for shares, the individual pieces of paper that's an evidence of ownership. So when the corporation forms, it has its charter and it becomes incorporated in a certain state, in the papers that are drawn up, they are allowed a certain number of shares that they can issue. This is authorized. They may never issue all the stock, but that's the maximum pool that they've got. Shares issued are those that the investors actually hold, that stock is issued to, and if they're not repurchased by the corporation, which we'll talk about later, Treasury stock, then shares outstanding are those shares that were issued and still held by shareholders. Par value is a requirement in some states. The original intent was that stock would be issued at a certain amount where cash would come in and assets would be held by the company to actually protect the creditors. There's enough owners, enough resources from those owners, the company holds on to those resources, and therefore they can pay back the debts that they borrow. Unfortunately, many of the companies have figured out that they set the par value pretty low, then there's probably not a whole lot of benefit to the creditors. So it's become somewhat an arbitrary value attached to a share of stock. Some companies, states figured this out, that it's probably not a whole lot of meaning, and they may allow no par stock, which they may set up a value for it called a stated value, or a true no par stock, has no value attached. And we'll see this later when we do the actual example about issuing stock. This group of ownership, if the company's doing really well, they have the most to gain because hopefully the value of their stock goes up and they have a choice of selling it or holding on to it. And if the company offers dividends, they may get some pretty good dividends. But unfortunately, it's very risky because on the downside, if the company's not doing well, you probably would want to, as an investor, be maybe a preferred stockholder rather than a common stockholder, because they're at the bottom of the list. So the company goes out of business, they're going to pay off their creditors, they're going to pay off the preferred stockholders. If there's anything left, it'll go to the common stockholders. So it's, it's a typical situation. Doing well, yeah, it'd be great to be a common stockholder. Company not doing so well, maybe you don't want to be this as an investor. Voting rights, they can vote on the board of directors, they can vote on certain corporate decisions and issues, which other classes of stock, like preferred stock, do not. If the company does issue more stock, they have a right to continue the same ownership. So if you, as an investor, let's say you own 10% of a stock, after new stock is issued, you are given the right to buy more stock to keep that 10% ownership. Also, you have the right, as an investor of this corporation, to share in dividends, to buy more stock or sell stock. And sometimes there's more than one class. There could be Class A and Class B with slightly different characteristics. Let's take a look at preferred stock. Not every company has preferred stock. If they do, these stocks tend to be without voting rights. So the common stockholders vote, preferred stockholders usually do not. Preferred stock, the word preferred, preference, they do have some preferences. They get their dividend paid to them if there's enough resources before the common stockholders get dividends. Also, in a liquidation, the company would pay off their debts, pay the creditors, then pay preferred stock, and then whatever's left goes to the common stock. So that's good news, which makes this a little bit less risky of a investment, though surely stock is still risky. It's not like you don't have a government agency backing up. You could lose everything. The dividends tend to have a cap on them. They often are a percentage of par, and that's the most they'll get. So in a really good time, it might be better to be a common stockholder, as we mentioned. In bad times, this may be a little more less risky. So cumulative is another feature that's common for preferred stock. So the good news here, if every year the dividend has to be voted and considered, if they pass over the dividends for preferred stockholders for a year or two, before they can give anything to the common stockholders, they've got to pay those dividends in arrears, those past dividends. So this is good news also for preferred stockholders. Dividends is another issue we can look at. You can reward your owners with cash. You can give them more shares of common stock or preferred stock. Or you can give actually a property dividend where you give them a piece of land, stock in some other company. That's not very common. So we're sticking with the most common is cash dividends, and then not completely uncommon are stock. Cash dividends, the company has to make sure they have certain things in place before they can do a cash dividend. It is voted by the board of directors, so it's not an automatic. There has to be obviously some cash, and the retained earnings balance has to be sufficient. You don't want to create a negative balance in retained earnings. So you've got to have profits that you've already made in the past that you haven't distributed in terms of your dividends. As far as we'll see the entries in the problem that follows. There are 3 official dates. You announce it. Apparently you don't have to announce it, and you could pay it right away, but usually you announce it, and that makes you legally obligated to do this. The date of record, you just check to see who actually owns the stock, so it's more checking out the subsidiary ledgers for all those owners, and then finally you mail the checks, which is the payment date. Impact on the statements, we'll see it a little bit. Simply less resources, and your retained earnings balance always goes down when you have a dividend. If you remember, dividends, revenues, and expenses are retained earnings accounts. And paying a dividend is part of financing on the cash flow statement, and no effect on the income statement. The stock dividend is a very different beast. Same kind of idea. It has to be voted. There's got to be enough shares instead of cash to do this. And there has to be enough previous profits where it warrants or justifies giving the owner something. It does have a 3 dates, so when we look at our example, we're going to go right to issuing or mailing out those shares to make it a little simpler. But the impact on the statements is one of those things most of us, probably don't think about intuitively. There's really not much change at all to your statements. Certainly not to the income statement or cash flow. And even on the balance sheet, it's simply a redistribution within stockholders' equity. Retained earnings goes down, and your paid in capital section where you have common stock, preferred stock goes up. So total stockholders' equity doesn't change. Total assets, of course, don't change, and total liabilities don't change. So it's really a fairly minor thing. But the one thing we do have to consider is if you give a stock dividend, you're giving up shares, and those shares you cannot use to issue, to raise cash. So it's an opportunity cost of having a stock dividend. I mean, maybe you have tons of authorized shares and you haven't issued many, and it's really not a problem. But if you issue all your shares, then you're limiting your choices in the future of raising money. If you have a stock dividend, one impact is you have more shares in the market. A small stock dividend may not have a big impact on the selling price of the shares in the market, but certainly a larger stock dividend would lower the price per share, usually in the market. Treasury stock, sometimes companies will actually go out and buy back their own shares. This creates, there's a couple ways of doing it, but the main way that most companies use is they create a new account, a contra equity account called Treasury stock. It's usually considered sort of a temporary thing because often companies will go back and reissue the stock later. Why would a company buy back their shares? Sometimes there's a group trying to buy up the shares and take over the company, fire management, and kind of start over. So if you're trying to prevent those people from doing so, you snap up your shares, buy back your shares, so there's fewer being traded in the marketplace, and preventing this group from getting 50% or more ownership or whatever they need. Sometimes they don't need the money anymore. They've done their purpose for having issued the stock, and they have plenty of cash but no real good reason to invest it. So certainly financing with equity is expensive. If you finance with debt, you get tax breaks with interest, but you don't for dividends. So sometimes they buy back the shares for that. Also, they may need the shares for a stock option plan or some other purpose, and maybe all the shares are issued. They don't have the ability to do that. Sometimes the market price is kind of sinking, and it may be to go in there and buy some stock, raise the price or keep it from dropping further, and improve earnings per share. Stock split is the last, I think, concept we're looking at here. If the price gets really high, sometimes there's a feeling that the trading is slowing down, that some investors may consider a stock to be overpriced or too expensive. And so to improve the trading, this at least is one theory, though maybe it doesn't do what it should, but you want to lower the market price but do it in a nice way, not because your company's doing poorly. So a 2-for-1 split, you double the number of shares and you have the par value. 3-for-1 split, you triple the number of shares and you take 1/3 of the par value. Splits then normally, with more shares out there of the same company, the market price usually drops. The weird thing is, how do you account for that? And basically, if you thought the stock dividend didn't do much to the statements, this one does even less. It doesn't even change within any of the sections. So basically, you have a lot of descriptive data with your balance sheet. So basically, that's all it does. It changes the description. The par value is different, the number of shares authorized different, shares issued different, shares outstanding different. Okay, so at this point, let's see if we can take a look at our example and sift through it. And I know for many of us, we don't buy and sell stock on a normal basis, so many of these things seem more foreign or more difficult. What I have here is a company that actually has been in operation for a while. So if we look over here, and I didn't do the entire balance sheet, but just the bottom part of the balance sheet, the stockholders' equity section, which is basically all that's looking where we're going to be looking at. Common stock is here. We've listed that first. This is really this whole section, which I should have probably put a heading. It's usually called paid in capital, which is what PIC is, or you could say capital contributed by shareholders. So within this, and the order doesn't matter, common stock is usually listed at par, so the 196,000 should be the $4 par value times the 49,000 shares issued. Hopefully it is. There's 50,000 shares authorized, so we only have 1,000 more shares that we can issue for common stock. Then we have another class of ownership preferred, 10% $40 par value shares. Here's where we get the dividend requirement. If we were just to do a quick calculation, we have $40 par per share times 10%. So each share of stock, when we do vote a dividend, we'll be given $4 per share. That's the dividend requirement. So that's the cap. Actually, sounds pretty good right now. But the common stockholders, could conceivably get more than that, but they could also get nothing or a lot less than that. We only have a few shares issued at the present time, so 1,000 shares times $40 par is what we present here. Then we look at additional paid-in capital, which is whenever you issue stock above par. And we can see common stock is 980,000. Just to give you a quick idea of what all that means, if we take the common stock of 196,000, which is the par value, plus the paid-in capital from past days. I think I got the right number of zeros. So that's the total amount you received when the stock was issued. Now, it's not the current market price. This is historical cost statements. But when you did issue the preferred stock, that's how much money you actually brought in. If I then divide that by the shares issued, and we have no shares, divide by shares issued, our average stock price when we issued stock previously was $24 a share. Okay, and then we have the same thing with preferred. So I've got the statement below this. I've got the general ledger just for the equity accounts. So let's jump in here. We are a Knick-Knack Corporation, and we this year on January 1st, we're issuing more shares of stock. So in the old days, when you probably first started working with accounting, we did cash. Cash went up when we issued stock, and common stock went up when we issued stock. Now with the par value, it's a little more complicated than that, because when we issue common stock, and I'm going to include this in the title, so we'll remember that. Common stock is $4 par, so I took this from here. Once a par, always a par. It doesn't go away, so we need to be aware of that. So how much cash we actually get for this issuance is 1,000 shares times $15 a share. So that's $15,000, and we've had a drop in price. Common stock is always recorded at par if you have a par, and of course we know we do. So we have 1,000 shares issued times $4 par, so that's 4,000. And of course we don't balance, and here's where this new account, additional paid-in capital, comes from. If I can spell it. And it's just simply is the difference between what you receive for the stock, the market price, less the par value. So it's a plug figure, whatever it takes to make the entry balance. We can see we've got 15,000 minus 4,000 is, of course, 11,000. So we'll plug that in there. Okay, so raising money with stock, you've done this before. I guess I'll go ahead and put the amount since it's a compound entry, but we have assets going up by 15,000. Additional paid-in capital and common stock are both stockholders' equity. We can see additional paid over here. So stockholders' equity goes up by the same. Just it takes two accounts now rather than one, of course. No impact on your income statement, and cash flow, raising money with stock, is a way of financing your company. So we'll put F for financing. Cash inflow, and I guess I could put 15,000 there too. You know, sometimes stock does its own thing. Okay. All right, so the next entry is raising money with preferred stock. If you can do common stock, you can certainly do preferred. Chances are, if we look, it's $60 per share. If we come over here, we see that preferred stock was $40 par. So again, we're going to issue stock above par. This time, my additional paid-in capital, which I forgot to do it in the last one, we can distinguish between them. We put in preferred stock is $40 par, so it's got a different par. Often it seems preferred stock additional paid-in capital, par value on preferred stock seems to be like it's set maybe higher than the common stock, at least in the examples we're going to do. So I should do additional paid-in capital dash CS, additional paid-in capital dash PS, PS, and allow a little space for it. And I'll come back and post the two of them after I finish this entry, so, which I should have done last time too. Too many things to do. So we are raising money on 1,000 shares, $60 a piece, that's $60,000. Our par value is 40, so 1,000 times 40 is 40,000, which needs to go into preferred stock. You always have to pick it up at par. And then, of course, to make the entry balance, we can see that the difference between the 60 and the 40, of course, is 20,000. Or another way to say it, the difference between $40 par and $60, $20 a share, times 1,000. Okay, so if you understood the impact from the common stock, guess what? Same idea here. We have 60,000 more in the resources. We've got additional paid-in capital and preferred stock added together. Both are stockholders' equity accounts in the paid-in capital. Nothing going on again with the profits and loss. And cash flow, yeah, increasing, and it's a way of financing your business. Okay, now let's post these. So I've got, I'm not going to trace cash either. We've got enough here to follow. So 4,000 in your common stock, additional paid for common stock, and that's a lot of additional pays, which could be combined later, but we'll keep them separate. And additional paid or preferred stock first is 40,000. Holler if I make a mistake, right? And 20,000 paid in capital. Okay, hopefully that's good, but again, I could easily make a mistake. Okay, not too bad. One extra account that we didn't maybe look at in the earlier part of the course. And then I'm throwing in revenues and expenses because if you look over here, I've got a 0 retained earnings balance, which means in the past, my profits probably have offset losses. Or maybe I had profits, pay dividends, and then had losses. But I cannot pay any dividends right now with a 0 retained earnings balance. So what I'm doing here, and also the other thing I guess I should point out is we're 2 years in arrears with dividends on preferred stock. So our preferred stock we're going to treat as cumulative, which is a normal characteristic. So we got to catch up on those things, and we can't until we have something, profits that will go into retained earnings. So I'm just going to throw in, not do closing entries with this, but we're just going to put it in here and recognize that we have profits now. Wouldn't that be nice? You could just type in, make up your profits. So we have $1 million of revenue, and expenses are $400,000. So we're having a much better year this year than apparently we've done in the past. Impact, cash in, cash out. So we have what? More resources by $600,000, right? The difference between $1 million of revenue less 400,000, or cash in $1 million, cash out 400,000, $600,000 cash. Revenue less expense means retained earnings would go up by the same. Your profits would go up by the same. And then last but not least, our cash would go up by the same. So good year. We needed a good year. Otherwise I can't give the investors any dividends. So December 14th, we announced that we are going to give a cash dividend. Because our stock is cumulative, which I probably should have said here, then, which is the majority of preferred stock is, then we've got to sort of catch up on things. So let's see if we can tackle that. 2 years in arrears. Okay, so what is our requirement for dividends? We have, what, $40 par times 10%. We talked about a $4 per share dividend, or we will, times, and the dividends in arrears, we're only going to look at the shares that were previously issued, not the new ones. This is from previous years. And so what we have there, if we do our calculation, is $40 par times 10%. Okay, it's $4 per share times the shares from the past years, $4,000. Okay, that would meet the requirement for 1 year. And then we have 2 years that we apparently have not paid these investors, and we'll assume those shares were held for the entire time. I know you can do that. 4,000 times 2 hopefully is 8,000. Okay, so that's the requirement to meet the past stuff. Current requirement would be that we have 1,000 shares originally, and that's the other thing we need to do. We need to track the shares. So let's put up the shares. CS and then PS. So right now we have 49,000 shares. We started with common. We issued an additional 1,000 shares. So right now we have 50,000 shares, right? 49 plus 1,000 hopefully is 50. Okay, I'll drop it down. We can change it as we need to, because we're going to need this when we do the dividends. And then the preferred stock started with 1,000 shares, and we issued an additional 1,000 shares, which is what we were starting to do a minute ago. So right now I've got 2,000 shares currently. So if I announce a dividend this year, then I really need to take, well, I'll go ahead and do it this long way. 40 times 0.10 times 2,000 shares. So that's going to be what? $8,000, which makes sense. So for the past year's 8,000, for the current year 8,000, add them together, and of course we've got hopefully 16, right? $16,000. Okay, that's going to take care of us completely, everything with the preferred stock. So let me throw that in there and hope I didn't make any math errors. Okay, so when you announce a dividend, you're legally obligated, so you're going to record dividends, or it's legal to record retained earnings. I'll put RE. You don't have to put this, but you could do either dividends or retained earnings. If you do dividends, then it closes later to retained earnings. And then you're not paying it yet. It's a cash dividend, so we're going to have dividends payable. And that's the preferred stock. So dividends announced means that I have not impacted my resources yet, but I am promising it's a current liability because you're going to pay it really soon. The dates usually are not that far apart. And dividends will cause retained earnings to go down, so stockholders' equity, no impact on the income statement. Dividends, even though as much as we want to put it on the income statement, it's not. And then there is no cash flow. And then it says declared at 50 cents per share on common stock. So again, we can't do common stock until we've made that commitment to preferred. If we look over here, common stock has 50,000 shares. So let's see if we can do the math. So common stock, again, has to be voted. They have to decide the amount. It's not an automatic. There's no percentage like preferred. So 50,000 shares times 50 cents gives me hopefully 25,000. Okay, so I'm going to put in 25,000. And the titles will be very much the same thing. In fact, you could make it common stock dividends, but I'm just going to do the exact same title that I did with the other, and we'll actually put them together. Okay, so same impact. I'm not going to show you the impact because it's the same deal. It's a cash dividend also. And then as far as posting, I would have 16,000 that I need for the recorded for the preferred, 25,000 for the common, which is well below that profit I'm making this year. Hopefully I'll make it. And then dividends payable, we're committed to paying 16,000 to the preferred, 25,000 to the common. Okay, so hopefully, maybe, I've updated that. And again, I'm not going to worry about posting the revenue and expenses. Just wanted to show you we do have sufficient retained earnings to do this. Date of record, the good news here is we don't have any journal entry. We would look and there would be tons of subsidiary ledgers. I really didn't do much, but each individual investor that you've got, you'd be looking to see how many shares they have, how much should the check be for each individual one. So there's a lot of subsidiary ledgers and a lot of record keeping with a corporation. But nothing in the journal. And then finally you'd make the payments. So what do we owe? Well, if I do the math here, again, that's why I thought we'd just shorten it and put it in the same account. 16,025 is 41, hopefully. So that's the balance right now. And so what I would do, just like paying any other bill, let me write no entry here. You would simply take off the payable. So we're going to reduce dividends payable, and we're going to credit cash. And since I have one dividends payable account, I'm doing the total. You could set up a separate dividends payable if you choose to for the preferred, and a separate one for the common, which would also happen. Paying bills here, nothing particularly unusual. Your cash is going to go down, which is an asset. Your liabilities will go down. No effect on your stockholders' equity or income statement. And then for cash flow purposes, you're making a payment and you're paying dividends. So this is going to be financing. Dividend entries are part of the financing activities because common stock, preferred stock, the investors is in the financing as well. Okay, and then I should pay over here, right? I should update this. So now we have a zero balance, which is nice. And of course, cash should be updated. Okay, then they decided, I guess because they really weren't doing that much for the common stockholders, to maybe go ahead and give them a special type of dividend we call the stock dividend. So if we're giving them a 10% stock dividend, this one's the one that doesn't really do much to the statements. It's a small redistribution within stockholders' equity from paid-in capital to retained earnings. So let's see what, let's do the math maybe first. Okay, so what do we have going on here? It's a 10% stock dividend. So if we go back and look, we need to know how many shares we actually have. So we have 50,000 shares that we've issued with common stock. Nothing has been repurchased. And for any of these dividends, we definitely would do shares outstanding. If I did have Treasury stock, I'd have to know the shares and I have to subtract that to figure out. So nothing else has changed the shares. So we would simply take 50,000 times 10%. Whoops, in the wrong place here. Times 0.10. Okay, so we have. So the stock dividend is going to be 5,000 shares. So let's put the 5,000 shares. We're going to need to set aside 5,000 shares, and we're doing this on just common stock. Okay, the value we're going to place on it is the value the stock is selling for on that date, which I just noticed I didn't give you. So let's see what we were selling it for. Let's go ahead and use the same thing here, $20. $20 per share. Okay, so the stock right now is trading on the 29th for $20 a share. So it's going to be 5,000 shares times, I'll just put an X, $20 a share. And we know what that is. 5,000 shares times the going selling price, the market price, would give me 100,000 shares, right? Yeah, I think that's right. We've got 4 zeros. Yeah. Okay, so so I need a dollar figure for those shares. And basically with the stock dividend, and oops, I need to be careful what I'm doing. Remember, once a par, always a par. So we're going to have dividends, and if I wanted to, I could have a separate account. Cash dividends could be separated from stock dividends. I'm going to throw them together. And then here we're declaring and issuing stock. So the stock we're issuing, if you remember, is good old common stock, $4 par. And whenever I issue stock, it doesn't matter for what purpose, it's got to be at par value. So 5,000 shares times par. Par value is 4. So if we do the math, 5,000 times 4 is $20,000. And that kind of makes sense that we do have an additional paid-in capital on common stock. Actually, this one is on stock dividends, but I guess I didn't set up a separate one, so we'll just go ahead and use common stock. Is fine. Okay, the difference between $20 and $4 a share, right? $20 selling price, $4 share is $16 above par times the shares, which I remember was 5,000 shares. So as you can just make it a plug figure, but we can prove it. It's $80 per share. So the impact of a stock dividend is kind of, again, it's interesting because retained earnings goes down, which is part of stockholders' equity, but common stock and additional paid-in capital are paid-in capital accounts, and they're going up. So it's really a stockholders' equity exchange, and the total stockholders' equity doesn't change. So therefore, there's very little effect on the statements. It does lower the market price per share because you've got more shares out there. A small stock dividend, which is 10%, 5%, probably isn't going to make a major impact, but it could make some. Okay, so we will enter the dividend that we just did, the stock dividend. Should we put, oops, I'm putting it in the wrong place. And you cannot pay a stock dividend because you're not giving cash. You're distributing shares, and that's a little complicated or confusing sometimes too. Okay, so that cash dividend, stock dividends goes both into there. We did raise common stock when we did this, so we can't forget about the fact that it does go into common stock. We do change the number of shares, and I just realized we went over by doing the stock dividend. We just went over the authorized shares. So I'm going to change my authorized shares. I'm going to cheat a little bit on this one. So we have 5,000 shares. That's going to be 55,000 shares in total. So I must have overlooked that. Let's come back up here and make this 55,000 shares authorized, or else we're in trouble already. Okay, doesn't change our numbers because we're going to assume the same number of shares issued. Okay, well, so much for my errors. Okay, so little impact of the stock dividend. Now we're going to repurchase stock. We're going to buy back our own shares. And let me just make sure. I think I didn't put in the, when we issued the stock dividend, additional paid-in capital goes up too. So let me throw that in there. Okay, buying back your shares. We use a new account called Treasury stock. It's a contra equity. We'll see in here in a sec. The math, this part is actually pretty easy because it's a one time we forget about the good old par value. It goes away. It doesn't matter. In fact, we know that we can't issue stock below par value when you initially issue stock. But once you get to Treasury stock, if you reissue stock from the Treasury, it doesn't matter about the par. So if I did the math right, and I think I did, 2, 3, 4, yeah. Treasury stock and cash when you buy back your shares. So you really don't go back. You know, the first inclination might be we go back, we cancel out what we did, we originally issued stock for the right amount, but what they do is they say, put it in this temporary account because chances are you're going to reissue stock at some point later. So we've almost issued all of our shares, so we're buying it back maybe because we need it for some other purpose. Buying back your shares reduces your resources, reduces the paid-in capital section, so therefore it reduces stockholders' equity. It does not affect profit, and it causes cash flow to go down. And issuing stock, raising money is financing. Buying back stock takes away, but it's still financing. And then I'll set up my Treasury stock account for $10,000. Okay, and I've got cash going down. Okay, this ends the entries for this particular period. So what I thought we could do is look at the numbers that we've got. And hopefully I've posted everything, but goodness only knows. So let's assume that I did. I think we only had one issue of preferred stock. I didn't do stock dividends. Okay. We did not buy back Treasury stocks. We haven't used that. We've got dividends recorded, dividends paid, which was 0, Treasury stock. Okay. Okay. Anyway, if I made a math error, sorry. So, yeah, let's do this. I don't think it'll take long. Common stock, if I did the math right, you simply add up everything that's been posted, and we'll use this in a minute anyway. So I hope that's right. 220,000 is the total. Preferred stock, interestingly enough, looks, that's right, we had 40,000 shares and we issued 1,000 more. So this again is at par. So that's 80,000. Let's see if we can't bold this so you can see the totals a little better. And of course I didn't allow space here for that, so I'm going to stick it on the side. So we have, what? 980 plus 11 plus 80. Okay, which hopefully is right. So 107071 rather. Okay, that's a total. And hopefully that looks okay. Okay. And then this one we can see is 30,000. 10 plus 20 hopefully is 30. And then dividends I didn't allow space for, so let's throw them to the right. And I do need to calculate that one. So we have 16,000, 25,000, and 100,000. The right number of zeros would help. So that's 141,000. 4100. And I figured that would do that, so we'll move it over a little bit. So that's the total. Dividends payable is gone, and Treasury stock is the balance. Yay. Okay, so if I take that and just simply replace the numbers, preferred common stock, of course, has gone up, and I'm not really using Excel. Probably should, but I'm not. And then preferred stock is now 80. Additional paid in capital has gone up. And preferred stock, I'm going to use this data for a stock split here in a sec, and I'm putting in the wrong number. Preferred stock is 30,000 additional paid. And I'll move that over just a little bit. Okay, on stock dividends, and I did, but you know what? I combined it over here since I didn't have a separate account, so let's just take that guy out. It was still on common stock. And then Treasury stock, we don't have an account for that. But less Treasury stock, here's what I wanted to show you. Treasury stock, I think, is 10,000, or let's see, did I get that right? 10,000, right. And so then if we just simply did an auto sum, I can do that much. Wait a minute, let me do this first. Well, it's not going to take much to do an auto sum of that, is it? Got to do that first. So if we simply add up this. So we have more total paid in capital, and then if we do an auto sum of, oh, you know what I forgot to do? Let's put into retained earnings. We made a profit. We had $1 million revenue, if you remember. Add an extra zero, less the expenses of $400,000 is $600,000. So, yeah. Retained earnings actually would be 600,000. I'll put it here. 600,000 profit, and then we had dividends. So the dividends are 141,000. So minus 141, and we can do that. I'll just do a calculator. So 600,000 revenue less expense minus dividends is 459,000. 459. I think that should be right. Revenues less expenses less dividends. Assuming the math is right. If it's not, excuse my math. Okay, auto sum, total paid in capital, retained earnings, and treasury stock. Treasury stock, for some reason, they present usually after retained earnings. Who knows why? Accounting is an art, right? Okay, so that's how the statement would look. You can see our stockholders' equity is reduced by treasury stock. It's a contra account. So let's slip down. Just got a few more entries. You can hang in there just a little bit longer. At the beginning of next year, we decide to reissue treasury stock. The stock is currently selling for 18. If you remember, when we bought back the shares, we paid 20. So this one, we're actually reissuing it but getting less money. Now, a lot of times it feels like a gain or loss, but it's not. You cannot make a profit or loss based on your dealings with your owners. Only if you perform a service, sell a product. So here, let's take a look at it. If we reissue the stock, it means it's back out there and we get some money. So here I'm going to collect 250 shares times $18 a share. I'm going to get $4,500 in. Okay, so that's cash coming in. Just like when you first issue stock, you've got cash and equity. Reissuing treasury stock is going to have a similar effect, but it's going to look kind of different. The hardest part of this is when you reissue it, you got to go back to the price that was originally paid. The original paid price was $20 a share. So it's kind of like when you sell a piece of land, you have to go back to the historical costs. That's the historical cost of the treasury stock. So when I take off treasury stock, I've got to take off, it's got a normal debit balance. To get rid of it, I've got to credit it, and I've got to figure out how much to take off. So it's $20 is what I originally paid for it. So $20 a share times 250 shares is $5,000. Okay. And I should bring this down. Let me do this to here. Whoops. And we'll just leave that. I won't worry about that. So we said the cost of those shares was $5,000, which is the $20 times 250 shares. So it went in at 20, it's got to come out at 20. I didn't get at least $20 a share. I got slightly less. So you can see I do need a compound entry. I need to balance this, and the balancing would have to be on the debit side, and I need $500. So another way of saying it is I'm $2 less coming in than what I paid to get the treasury stock times 250. And again, it feels like a loss, but yeah, you want as much cash as you can get from equity transactions, but it's not a true loss. So when in doubt, use additional paid in capital. Let me see if I can shorten that. Additional paid in capital dash TS for treasury stock. Usually you don't create a debit balance in that account, but we're going to assume that we're going to have a positive balance when we finish the year. So I'm not going to worry about that at this point. You could, if you don't have any previous balance that's set up, which it should be a credit balance, you could also debit retained earnings. For our purposes, this is fine. So what the heck does that do? Well, cash is going to go down by $4,500 because assets go down because cash is going down. If you reduce a contra equity, two negatives make a positive, you're actually increasing equity, right? Treasury stock recorded initially reduces equity. Treasury stock taken off the books increases equity. So additional paid-in capital will cause equity to go up. Excuse me. Reducing additional paid-in capital will cause equity to go down by 500. And maybe what I should, let me just do it this way, minus 500. But taking off treasury stock will actually cause equity to go up. So to try to sort of prove it, in the end, when the smoke clears, the stockholders' equity does go down by $4,500, which is the difference between the two. So I'll bold that to show that's a total. So assets down, equity down, $4,500. And there's no effect on profits. You cannot, again, make a profit dealing with your owners. And then anything to do with equity, stockholders' equity transactions, common stock, preferred stock, treasury stock, would all be part of financing. Okay, that's a major impact. So treasury stock has gone down by $5,000. Of course, we haven't gotten rid of all the treasury stock. And additional paid-in capital, treasury stock is a little weird looking right now. That's okay, because in a minute it will be okay. And then at the end of the year, we assume we issue more shares of treasury stock, for this time for 30. So the price has gone up. So I'm going to receive cash. I'm going to skip a space. Again, I have to take treasury stock off the books. And if 250 shares cost $5,000 from the first reissue, then guess what? The other 250 also cost $5,000, which gives us a total of 10. Or another way to say it is we paid originally $20 a share. So 250 times 20 is $5,000. What we receive for the shares this time is going to be 250 shares times 30. So this is good news for us. We've got more resources coming in this time than what we paid for the stock. And we can see to make this balance, you really need a credit. And it's the difference between the two sides. So you can plug it, which is $2,500. Or another way of looking at it is it's the difference between the fact that you paid $20 per share and now you're issuing it for 30. So 30 minus 20 is $10 more that's coming in times the shares, which is $2,500. If you're not sure about something, probably it's additional paid-in capital. So there's additional paid-in capital from treasury stock. So once again, we're using that account, but notice this time, fortunately, it's on the credit side where it should be, and so the good news is we now have a credit balance of $2,000, which is a normal balance for that account. The impact, similar to what we did before, except this time we have $7,500 more resources. If you net the additional paid-in capital going up, treasury stock going down, which also increases, they're both increasing. What did I put a negative for? Sorry. Assets are going up, equity is also going up by $7,500 by reducing the contra equity and by increasing the equity account. No effect on profits, and for cash flow purposes, no surprise, we have more resources in the cash area, and that's financing. Okay, hang in there just a little bit longer. Now we see the prices of our stock shooting up 1 year after this, and so we announce a 2-for-1 stock split. Okay, again, the best way to do this one is actually to edit the description up here. One way to accomplish that, if you want to try to make it a journal entry, is let's look and see. And again, I hope I updated everything, but who knows. We're looking at the common stock account, and I think hopefully we issued common stock. We had a stock dividend, and what was we had a beginning balance, right. Okay, so I think this hopefully is the right balance, $220,000. Let's hope. So notice we have common stock $4 par. When you do a split, and let me see if I can find sticky notes. There they are. I like to use these sometimes, but anyway, when you have a split, everything's going to update. So one of the things that's going to happen is it's a 2-for-1 split. So you have $4 par times 1/2. Your par value goes down exactly by half, so you've got $2. Your shares all get adjusted. So authorized shares were originally, if we go back and look up here, I lost my sticky. Oh, you know what I didn't do when I changed the numbers? We issued 1,000 shares. Yeah, I forgot all about the share update. You got to do that. So you had 49,000 plus 1,000, and then treasury stock, or stock dividend, and then the treasury stock. So I forgot to do it. Sorry about that. Treasury stock was 500 shares repurchased. Okay, so at the end of the first period that we dealt with, it's minus 500. Okay, and that's actually shares issued and outstanding. So I would show, yeah, both of those. Yeah, let me take this off for a minute. So we did have 55,000 shares issued, which would fit with the amount, hopefully, that we have here in the, and I think it does. 220,000 represents 55,000 shares issued times $4 par. But in addition to that description, I should say 55,000 issued, comma, 54.5 Treasury. May not fit. I also misspelled it. Gosh. Okay, put that A in there. Okay, so when we did this, I should list under treasury stock, which I forgot all about, 500 shares are held in the treasury. So of 55,000 shares issued, 54,000 is actually outstanding. I didn't mean to put, I'm going to put outstanding. How about if we do it that way? So there's 3 different categories: authorized, issued, outstanding. Outstanding is a little bit less because we have 500 shares held in the treasury. Okay, so when we get to the split, which is where we were headed when I realized we hadn't updated that, 2-for-1 split is going to change shares. One way to show it is to create a new common stock account. So instead of just a $4 par, remember how we did the par value goes in half because of 2-for-1. So it's 2, and then let's go ahead and finish this. The authorized shares are 55,000 doubled, right? So 55,000 times 2, we're almost through with this. It's 110,000. Shares issued. From last year, we had 55,000 shares issued. They're going to be also doubled. And of course, we had issued all the shares because I made a mistake on that. So shares issued happens to be the same as shares authorized. And then shares outstanding, which means those held by shareholders, is 500 shares less. So that would be doubled. And so if we did that, we have what? 54.5 times 2 is 109. Okay, that makes sense, I think. Okay, so what we would want to deal with then is either write a sentence to describe this or go common stock $4 par, and then you create a new account called common stock $2 par. So at least the description will change some. And so all we can do is we can move the balance that we already have from the one account to the other. Now I'll admit I didn't, let's see. Now it shouldn't hurt common stock. We didn't post all the treasury stock reissue entries, but I think we're okay. So here's the 220,000. So take the balance of 220,000 and simply move it over to your new account. That's one way to capture that. And of course, impact on the statements is virtually nothing, so I'm not going to put anything down for that. And then what it will do up here is change the description. It'll be $2 par. And then I guess we can do all this. Let's throw this up here. There's our sticky note. Yeah. So after it was split, again, realizing I didn't update the reissue of treasury stock. Well, actually, the reissue of treasury stock would mean there's no treasury stock left because we reissued it. But the additional paid in capital would have changed for it. But let's go ahead and we'll stick with what we're doing here. So part of the stock split, if I can get it out, changes the description. So up here, it's going to be $2 par. Remember how we doubled the shares? So if I throw up my sticky again, it's 110,000. 110,000 shares authorized. Okay, here's the new. Let's go ahead and make it red so it shows up a little bit. Okay, so that's changed. All of this has got to change too. And that's what you're doing with a stock split, is changing the shares and hopefully the selling price per share. So now you have 110,000 shares issued. Whoops, darn it, I just did the wrong one. Here we go. It's 110, maybe, okay, now I'm on the right one. 110,000, so your shares went up, and then I see what I did. And then all I have to do is change the, if you remember, all categories have to change. Authorized, issued, outstanding. Outstanding is now 109,000. So 109. Okay, so you'll notice I didn't have to change the number, but I did change the par value not to half. The shares authorized doubled, the shares issued doubled, the shares outstanding doubled. And if we had treasury stock, which actually right now we don't, but if we did, it would be doubled as well. And I'm putting 0 because we don't have that. And yeah, the impact on additional paid in capital with treasury stock would have been, let me see if I can finish that. Treasury stock was completely gone, of course, by the end. And additional paid in capital, I think I actually did put that. Okay, both of those are in there. So our balance would be 2,000 up here for treasury stock. Anyway, so yeah, some new journal entries. Most of the impact, as you can see from what we've done, has been on the balance sheet and the cash flow statement. There's very little else going on. Not much of anything for profits. So yes, so hopefully this helps to understand the basics with corporate accounting.